Thank you, Robert. Thank you, George, and thank you very much for asking me to be here. I feel very honoured. I've had a bit of a sort of warning kind of preparation with George beforehand. When George tells me, "Well, the whole class has been to see Warren Buffett, and Walter Schloss came to teach, and other great luminaries of the value investing field have come to teach." So I know what company I'm in. And it's an honor to be asked. I'll spend 10 minutes on our approach. I'm not, I promise you, trying to sell you anything, but I think that it's very difficult to talk about value investing as a practitioner without putting it in the context of what we as a firm do. So I'll spend about 10 minutes as an introduction talking about our approach, and then become more specific about the challenges of value investing, and then talk about some particular examples, a couple of stocks. So this is a little organogram which takes us through really the agenda which George set me in asking me to come to speak today. Our investment philosophy, as we were discussing just before we came here, is something which I think is innate. My belief is that you can learn how to do value investing, but whether you are a value investor is something which is pretty much innate. Of course, you can modify your inclinations over a lifetime, but I think that value investors are born, not made, and you will all know whether you are innately value investors or not. It's in the blood, either to be the curmudgeonly type who looks first at valuations, who's interested in cheap stocks, or the lover of glamour who is interested in growth and in lines which grow to the sky. And I think that is a basic divide among most investors. There are some who are far more flexible than that, including the greatest of them all, Warren Buffett, who, though classed as a value investor, I think in some ways has confused the language of value investing, because to buy Coca-Cola is not a value investment. Because Warren Buffett is regarded as the greatest value investor of all time, people think, well, if he's buying Coca-Cola, Coca-Cola must be a value investment. I think that's not the sort of value investment of which I am talking, which is far more the kind of deep value investment which people like Walter Schloss and Peter Cundill in Canada practiced. So what we do is we run very concentrated portfolios. We run portfolios typically of 20 stocks. We do believe in diversification. I think it's very dangerous to have a manager who has a single big idea and who makes sure that that idea is reflected in every nook and cranny of the portfolio. We all know how easy it is to be wrong in investment. And if you have the big idea which is reflected in every stock, and it's wrong, then you get blown out of the water. And so diversification across, in our case, as global investors, countries and sectors and ideas is very important. But you can do that, all the academic studies show, with as few as 15 stocks. And if you're aiming at diversification, then after the 15th, the 16th and the 17th and the 18th do very little in terms of risk reduction. So we aim at a volatility which is not much greater than that of equities generally. We are not top-down. We're trying to invest in companies which are essentially sound at very low valuations, irrespective of their country. And so the country weightings simply drop out of the stock selection. We have had in the 18, 19 years that we've been doing this, I've been doing this in this way. We've had as much as 40% in Japan. We've had as much as 30% in France. It wasn't a statement about France. We held Lafarge and Vivendi and Renault and Sanofi, and that made 30% in a concentrated portfolio. We've had as little as 6% in the States. We've had as little as 0 in the UK. So we don't mind being absent quite major countries or major sectors, there is plenty to worry about in the portfolio without worrying unduly about what is not in the portfolio. But everything is triggered by value. And by value, we mean value in an old-fashioned way. We look at value in terms of earnings, in terms of cash flow, in terms of free cash flow, and in terms of assets. And our favorite hunting ground is where you have a significant discount to assets that is very apparent. And at its most extreme, where you have a holding company that has a whole lot of holdings which are themselves quoted, you sometimes get really extraordinary anomalies, and then I think you want to seize them. So the Swedish company Investor goes through cycles of being held in low regard by the market because the Wallenberg family who run it goes through those cycles of low regard themselves. And that company largely consists of quoted assets, but occasionally goes to as much as a 40% discount. 4 years ago, Renault was selling at 27 euros a share, and the value of its stake in Nissan alone was 50 euros a share. And that is an absurdity, because however bad the core operation of Renault might be, it could not be worth minus 23 euros a share. And that kind of anomaly usually resolves itself, as it has done in that case. So that is our broad investment philosophy. I'll just mention one very concrete result of that approach, and that is that we recite the mantra that a share price which has fallen is prima facie more interesting than it was before it fell. All my investing life, I've thought the great battle is to avoid becoming more enthusiastic about what has done well and to avoid becoming more gloomy about what has done badly, but on the contrary, to look at with greater interest at what has fallen. And the concrete result of that is that we so often find that we have bought an initial chunk of something too expensively, with the benefit of hindsight, but the second and third chunks at a new improved price have been a notable success. And I could give you countless examples of that. And of course, I can also give you examples where it doesn't work. The value trap, where you buy something because it appears cheap, it gets cheaper, you buy more, it gets cheaper and cheaper. It maybe reaches the ultimate cheapness. That is very painful. But I think that value traps are the occupational hazard of the value investor. And we try not to stumble into them, but of course we will stumble into plenty. And if they didn't exist, then of course the proposition wouldn't work, because it would be too simple. They have to exist in order for the proposition generally to work. And overwhelmingly, we have benefited from having a second and third bite at a cherry of which the first bite was maybe premature. So that's our investment philosophy. To define the area of interest, we're interested in equities only. That's a circle of competence thing. If we were cleverer, we could look at all sorts of different securities. We don't. We're not interested in derivatives, and we are long only. We screen for opportunities in two ways. One is a buy-eye screen. For 25 years or so, I have been through the MSCI Blue Book, which is a hard copy which summarizes all the valuations of the MSCI global universe and other data. And out of that, there is usually every month, there are usually half a dozen or so companies which spark an interest by virtue of their value characteristics and also the background knowledge that we have. And then the other thing we do is to screen by pressing buttons on a computer. We do that very frequently, non-routinely, and using a variety of measures. And there again, there will be a number of companies which spark an interest, and we then do more work on those. What does that work consist of? It consists largely of sitting at the desk with, as it were, the green eye shade that Ben Graham would have worn or recommended. We don't carry to the Graham extreme the view that you should not visit managements and you should not visit companies. Ben Graham said you should never go near a company because it simply biases you. But I do think that there is such a thing as visitee bias. I used in the 1980s, I was head of the US equity team at Mercury Asset Management, and I used to spend a huge amount of time visiting companies. And I saw Walmart year after year, and I always came away thinking this is worth 2 more on the multiple than before I'd gone. But it probably wasn't. It was just that the CFO, with whom in those far-off days you can get a one-on-one meeting, the CFO was very good at, as most CFOs and CEOs are, at spinning the company a story. And he sat in a tiny little office with sawdust on the floor, and he pointed at his banged-up old Ford in the car lot, and you thought, gosh, this is the Walton cost-cutting ethos. So visitee bias is something that we are wary of. We don't run away from managements, and I will, if there's time, give examples where meetings with management have been fantastically important to us. Assessment of management is always important, but we believe it is better done through reading about them, looking at what they've done, talking to other people about them, than it is by the hour or hour and a half that you get in the company of the CEO or CFO. So it's largely a job of analysis which begins with what we call a 2-pager, which summarizes the issues. There are always then plenty of things to spend a lot of time on. We've spent as many as 12 consecutive weeks looking at different issues relating to the same company. We have a valuation target for every stock, and that is a combination of a multiple, which is a PE multiple or a price cash flow or a free cash flow yield or a discount to assets, and a variable, the earnings or the cash flow or the assets. And we tend not to revisit the multiple once we have fixed it, particularly if things are going well. It's very tempting to come back to something which is exceeding expectations and say this is worth not the 12 times that we thought it was, but 14 times. But if you do that, there is an element of double whammy about it. And so we tend not to do that. On the conservative side, when things are going badly, we do quite often lower the multiple to be sure that we still have enough gap between price and value. But if things are going well, we tend not to. But the variable, of course, varies. And the ideal variation would be if earnings were to go up by 10% a year, the stock were to go up by 10% a year, and we could hold forever. But of course, life is not like that. If we get to the price which is implied by the valuation target, then we tend to sell pretty abruptly. And that valuation target, intrinsic value, other people call it, is an extremely good discipline in getting one to sell. Accounting for risk. We do not regard, I said something about volatility. We care about the volatility of the overall portfolio. We don't want it substantially more volatile than equities. That's partly for our own comfort, and it's partly for our investors' comfort. But we don't care very deeply about the volatility of individual stocks, and we don't really regard risk as being measured appropriately by volatility. And we absolutely do not regard active risk as a measure of volatility. Active risk was invented in my lifetime. It was invented at the end of the 80s. And it had, and probably a little earlier, but we only heard about it at the end of the 80s. It had been called tracking error for decades before that. Very good description of an index fund, which, if it didn't imitate the performance of the index, had a tracking error. It was imported to the active management world during the 80s and under the new name active risk. I won't dwell on this because I expect you're all already of this way of thinking. To us, is a ludicrous measure of risk. It doesn't measure the real risk to an investor. It measures a business kind of risk, the risk that the manager isn't deviating too far from an index, but it doesn't measure the risk that an investor faces. The risks that we try to control are, one, overall volatility of the portfolio through diversification, but we don't care about the active risk, the risk in relation to the index. We care about the absolute level of volatility. Two, leverage. We don't like leverage. We particularly dislike the combination of operating leverage and financial leverage in the same company. So we've held very often pretty cyclical companies, but with net cash positions or very strong balance sheets. We held POSCO, the steel company in Korea. You can't get more cyclically, operationally leveraged than a steel company, but it had net cash. We do make exceptions, and in fact, the stock that I'm going to talk to you about later was an exception. But overall, the leverage in aggregate in our portfolios is always a lot lower than that of the indices. And that, I think, is very important to a value investor, because one of the things that you need as a value investor is patience. You need to be able to invest for the long term. If you have a dodgy balance sheet, and particularly if you have a dodgy balance sheet and a cyclical company, then you have a major risk. And so strong balance sheets are very important to us. And then I think the third control of risk is the business of value itself. It doesn't mean you don't make mistakes. It doesn't mean there aren't very difficult times. But at least you can remember why you were there in the first place. I think if you buy a stock on 50 or 60 times earnings, of course I'm slightly stylizing this, but if you buy a stock which is on 50 or 60 times earnings, and there's a disappointment, and it's now on 40 or 35 times earnings, you still don't know quite why, in valuation terms, you got it. I think that with value stocks, the mere fact of a low valuation is a comfort and prevents you, or makes it less likely that you will do something stupid when there's a disappointment. And then the final item, investing in portfolio construction. Execution is all. We have 20 stocks in the portfolio. The average holding is 5. We buy too early. When we analyze all the things that we do wrong, we buy too early, we sell too early, we hold for too long. We do all these things, and we try to correct these sort of behavioral mistakes by at least analysis of what we do. But I think that buying early and selling early are things which we shouldn't be too apologetic about. I think they come with value territory. I mentioned patience. When the talk that I gave in last year, I called patience, 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 which was the maxim of Peter Cundill, who was a very noted value investor in Canada, retiring in 2006, and of whom I'll say something more in a moment. And it's a very appropriate maxim, because patience is an ambiguous term, or a term with more meaning than one. Not only does it mean you should wait and be very long term, but patience also is synonymous with suffering, as in the Passion of Christ. And suffering is something that value investors get used to. You have to be good at suffering. And then it is also synonymous with passion. And I think that the passion of a value investor, the enthusiasm of a value investor, is also necessary to doing the job. That's quite enough on one page. The other pages aren't going to take quite so long. Where are we now? I don't know whether you're acquainted with this. This is a very good sort of illustration of the necessity of patience. Most value investors have had a pretty raw time over the last several years. This is a graph which shows the relative performance of the MSCI World Value Index and the MSCI World Growth Index. And since 2006, growth has absolutely trounced value. This has been the longest period, certainly in my experience, and I think probably in recorded history, of growth outperforming value. Over the long term, as you will all know very well, the odds favor the value investor, but they don't favor the value investor all the time. There are long periods in which value investors find it extremely difficult to cope. And this has been as severe a period as 98, 99, 2000, which was an extraordinarily polarized and grim period for value investment. And it's been longer than that time. And I'm going to touch briefly on the experience of 3 managers all of whom are managers whom I respect enormously, and at any stage in the last 15 years, I would have wanted to put money with those managers. But I think their experience illustrates very well this necessity of patience. And I wanted to do this early on in this talk because what you are doing as a course, which I know to be a fantastically good course, is nonetheless a desk exercise, and you're not in the hurly-burly of the investment world, although you may be making recommendations to the fund, so perhaps you are, but you're not under the pressure which professional investment managers are under. And I wanted to illustrate to you just what that pressure is like, because value investing, you can explain it methodically as a kind of dry, intellectual, enthusing and exciting, but nonetheless quite abstract exercise involving a great deal of method and process, and also strong character. But that is far removed from the pressures that professional investment managers are under. So I wanted to show you these three managers' experience. And the first is Longleaf Partners, otherwise known as Southeastern Asset Management, founded in 1987 by Mason Hawkins and Staley Cates. Extremely well known in the value investing world, probably well known to a good number of you. They had their golden years, and you can see them on this chart, between 1991 and 1994, huge outperformance every year. That was followed by disastrous years in 98, and then culminating in 99, when they were 17% behind the index. They were plus 3% or so. This is the S&P. The S&P was up 20%. And the result of that is that by the end of 1999, they were, over the trailing 5 years, they were 10% per annum behind the S&P. That's a huge margin. And indeed, over the 13 years since their inception, since 1987, by the end of 1999, they were underperforming since inception over 13 years. So would you, if you were a plan sponsor, if you were running an endowment fund, would you have appointed Longleaf at the end of 1999? Well, you should have done. It won't surprise you that this is the next installment. In the next period, 2000, 2001, 2002, they had a golden era. In 2000, they were plus 20%, and the market was down about 10%, and then something pretty similar in the following year, and outperformance in the next 2 years. And incidentally, I mean, I was both investing directly global equity portfolios at that time, and also as the boss of a family office, choosing other managers, and we did in fact put money with Southeastern Asset Management in 1999 in that particularly polarized period in markets in which the tech boom had happened. And on the one hand, you had tech and media and so on at ludicrous multiples. And on the other, you had a whole lot of excellent companies at very moderate multiples. The world is probably never going to get quite as polarized as it was then, although it's not very far off it now, but probably not quite as far as it was then. So patience was rewarded, and their investing in the approach. They certainly didn't offer a track record at that time, but investing in the approach was very strongly rewarded. That, though, is not the end of the story. To bring that last chart up to date, in the last several years, they have been, in the last 5 years, 7% per annum behind the S&P, and their 10-year record, too, is behind the S&P. So what now? as I said, at any stage in the last 15 years, these are people that I would want to put money with, and that applies today as much as then. But this is an illustration of just how painful it can be. Phoenix in the UK is a quite remarkable manager. In my early time in investing, I used to say that the best place to run money from would be a garage in Battersea, Battersea being a suburb of London and happening at the time to own a garage in Battersea. And then about 10 years ago, or maybe a little more than that, 12 years ago, I came across Gary Channon, who runs Phoenix Asset Management, who runs money from a garage in Barnes, which is another suburb in the UK. And he is a deeply brave manager, prepared to have an enormously concentrated portfolio, as much as 35% in one stock. This is his record. This is his record to the end of 2008. So the first 5 years, terrifically, fantastically successful. And then from 2003 or 2004 to 2007, 2008, some very large underperformance. And as a result of that, by the end of 2008, he had a 5-year trailing record of 9% per annum behind the index. Again, these are figures which are very difficult for clients to cope with, and you need a really good understanding between clients and manager to tolerate this. You need a very good understanding for prospective clients to become actual clients after a record like this. And then he had some electrifying years from 2009 to the present day. And so after that 5-year period in which he was 7% per annum behind the index, now he has 5 years in which he's been 9% per annum above the index. And had you invested in 1998, the £100 would be £522 with Gary Channon and £220 in the FT. So again, in the FTSE index. So again, an illustration of the necessity to be very long term. And then finally, Peter Cundill, who was rather my mentor, one of my mentors, and who had a book written about him which is called "There's Always Something to Do." And I learned only this evening that that was not, in fact, his original aphorism, but the aphorism of Irving Kahn. He was, again, an extremely brave investor. Here is his record from 1975 to 1998. At the end of 1998, after 24 years in the business, the $100 invested with him was worth less than the $100 invested in the MSCI World Index. And that's a pretty depressing thing for the manager to contemplate, and for his investors. And then, in the next several years, electrifying performance in 2000 plus 20 versus minus 10 for the index, much similar sort of outperformance the following year. And so when he retired in 2006, he had about the best track record of any Canadian investment manager. He retired in 2006. The fund continued under his colleagues, and at the end of 2010, the $100 invested with him at the beginning had become 10,000, and in the MSCI World 3,500. And yet, only 6 years earlier, he had been for 23 years an underperformer. That I think really sort of encapsulates how important patience, the long term, is, and how you can wait a long, long time for value to come through and for your approach to be vindicated. What all these managers shared was a belief in the long term, a belief that volatility is given exaggerated in importance, a belief in value, and an iron constitution. They kept it simple. They concentrated on the key issues. They were nervous, all three of these, about analysis paralysis, the danger that you ask 27 more questions, you go out and look at 7 more comparators, and that enables you to avoid coming to a decision. In my experience, I think there are 3 parts of the investment process. There is analysis, there is judgment, and there is action. And there can be quite a big gap between each of those. You can analyze terrifically well, but fail to come to the judgment. You can come to the judgment, but fail to act on it. And all 3 of those you need to be strong in all 3 and not to be prone to analysis paralysis. They also were people, they kept it simple, they concentrated on the key issues, and they didn't talk in fancy terms. I came across the following description the other day or something. We maintain a positive view of the company's improving optionality regarding further asset structure optimization. What does that mean? It means the company may sell some bits. Anyway, these people, they kept it simple. So that, as I say, is an introduction I wanted to give you some sort of perspective about the difficulties of being a value manager. And I come to you, by the way, not as somebody boasting about immediate past success. We've had a very difficult time in the last 4 years. I need your sympathy. No, this is a sort of fundamentally important chart with which you are probably familiar that, as it says in the caption at the bottom, this is the production of, well, it says Société Générale, but I could have sworn it was Tweedy Brown. What you pay, not the growth you get, is the biggest driver of future returns. And all sorts of people have done work on this. What this chart shows is the 10-year return divided by different starting point in terms of Graham and Dodd PE, which is, broadly speaking, the same as the Shiller PE. Bob Shiller has slightly tinkered with the Graham and Dodd PE, but both are today's price divided by the average of the last 10 years' earnings, and thus they get rid, therefore, they smooth out the cyclicality, the peaks and troughs of earnings, and they give you a longer-term measure of value, and this says it all, really, that when it comes down to it, the starting point in terms of valuation is the chief determinant of returns, and if you pay a low multiple, you tend to get a high return. If you pay a high multiple, you tend to get a low return. And of course, it's in the nature of the low multiple environment, either with a market or with a particular stock or sector, that at the time that there is that low multiple, the circumstances are very difficult. Otherwise, there wouldn't be the low multiple. And of course, it's also in the nature of those circumstances that it's very difficult to foresee good times ahead, because you're surrounded by trouble at the time that you're looking. But you have to, I think, return to the objective fact that low multiples lead to high returns. And expressed a different way, I came across this chart the other day, but it's the expression of a sort of a cycle of moods, which is well known. And in fact, well, no, I won't get, yeah, which is well known. So these are the various stages in the moods of the market. David Fuller presented this the other day in London. He is a technical analyst. It was the question at the bottom of this page is what he asked: where do you think markets of most interest you are in this cycle? And I do sort of pose that question and then give an answer. I mean, I would say that none of us would really feel that markets are over on the left-hand page, or perhaps we would, but I don't think on the left-hand side. They're more on the right-hand side of the page at the moment. Different markets in different positions on that right-hand side. I would say that the world markets in general are somewhere around between denial and fear and panic, with elements of panic in the last couple of weeks or so, and value. The value portion of markets is closer to panic and contempt than it is to denial. I think we've got to that stage that we had in 2000, when very sophisticated, intelligent, experienced people would say, you just don't get it. There's a new paradigm, there's a new economy, all this old-fashioned stuff, you don't get it. I had lunch with a very well-known, very successful hedge fund manager in London a week ago, and after which he sent me an email which began, I think value is stuffed, which was very encouraging. And he then told me why he thought it was stuffed, because of the disruptive influence that we know in all sorts of sectors. And Howard Marks of Oaktree, who writes a great deal of terrific stuff and runs a very successful value firm, is very good on this. And what he says is that it's not that these fundamental things are not happening. Of course they're happening, otherwise there wouldn't be a tremendous fuss being made about them. So in 99, 2000, of course there were huge technological strides being made in the mobile telephone market, for example. And now there is disruption in just so many industries, one after the other. It's not that these things aren't happening, they are happening, but they get exaggerated. And I remember in 2000, when we were very polarized, we had nothing in tech or telecom, and very painful time up until March of 2000, and then wonderful time thereafter. I remember saying in early 2000, when I was at a meeting, very senior people, one of whom said, "You've been saying this for ages, tech is too expensive." And I said, I talked about the mobile telephone market and the valuations on mobile telephone stocks. And I said, these valuations suggest that there are going to be 6 billion mobile telephones in the world. Well, what could be more ludicrous than that? Well, of course, now there are many more than 6 billion mobile telephones. So it wasn't that it wasn't happening. It was happening, and it did happen. But markets exaggerate this, and markets in 2000 had hugely exaggerated in the valuations, the position of tech and telecom stocks, and conversely had undervalued old-fashioned things. And contempt comes, that last line, that really painful time when people say, you just don't get it. Can't you see there's a new paradigm? It comes to the value investor, because 75% of the time, the value investor, the deep value investor, is investing in things in which people think he's daft to invest. He or she is daft to invest. And of course, sometimes they are right. And that's what makes it so difficult. And that's why value investing is not done more often than it is. All the records show that the odds favor value investing. But why don't more people do it? Of course, if they did, it would immediately get rid of the advantage of it. So it's just as well that they don't. But why don't they? They don't because it is emotionally difficult. And people like Seth Klarman, who I know has come here and writes very brilliantly, he has expressed it in those terms, that it's emotionally difficult to do. And so it's the behavioral aspect, which is the most difficult aspect of value investing. This expresses it another way. You have to invest when you're terrified. And Jeremy Grantham headed one of his extremely thoughtful pieces, Reinvesting When Terrified, in March 2009. Not bad. That was the bottom of the market. So now I come to the more specific. Where is the value now? How are we doing? Not bad. First of all, we see very little value in the US. Of course, that's a big generalization. And quoting Peter Cundill again, there's always something to do. So there are corners of markets in which there will always be excessive gloom and there will always be something to do. But in general, the US is a difficult place to find value in. This is the performance of the US compared with the rest of the world. Of course, we reached these peaks of performance before. There's nothing to say that, there's no sacred rule that says that we can't just carry on like this. There's nothing to say this is a peak. You only know afterwards what a peak looks like. But the fact that it is now through the levels of previous peaks of past outperformance suggests that it is likely that we're close to the peak. And of course, that is also reflected in valuation. The Shiller PE, or the Graham and Dodd PE for the US market, is extremely high, and it's almost double, in fact, the level in Europe or in Japan. And a place where we do see an enormous amount of value is Japan. This shows the price to book value. The Shiller PE is very low. And moreover, in Japan, you are getting now an emphasis on return on equity, which is really novel. It's on both ends of the return on equity formula, both on profitability, companies which historically have been fairly sloppy about profit, with the Japanese culture of corporate management being very different from US or UK culture. Now putting much more attention on costs and on profitability. And it's also on the balance sheet. And this is manifested in an enormous increase in share buybacks. Share buybacks in Japan last year totaled about 4 trillion yen, and that is roughly double the level of any previous year. In the States, in the first half of last year, share buybacks were 130% of the net income of listed companies. In other words, they were being done from borrowings. And I think one can be a bit cynical about the financial jiggery-pokery that is involved in share buybacks, which are done particularly at high levels of prices with borrowings. In Japan, the comparable figure is 30% of net income has been spent on share buybacks. And moreover, these Japanese companies have oodles of cash in their balance sheets. And that is something which we Western investors have tended to criticize them for years, because it's a very unproductive asset. And this pressure for emphasis on return on equity is coming from above. It's coming from the Abe government. It's coming from the authorities in a new stewardship code and corporate governance changes. And it's also coming from shareholders. Institutional Shareholder Services, which is the largest proxy voting service in the world, is recommending shareholders to vote against the re-election of directors where the return on equity is less than 5% in each of the last 5 years. Pretty strong stuff. And they are pretty influential. And companies care about this. And so there's the creation recently of a new 400 index, where one of the criteria for inclusion is a decent return on equity. And companies which have found themselves excluded from that index have been anxious to get into it and have been buying back shares in order to do so. Amada did it, Mitsui did it, various others have done that. And so we're seeing a real change in the corporate management climate in Japan. And whereas in the past, for some years, you could say that there has been a big gap between price and value in a lot of Japanese companies, but you could never be sure when the management was going to make an effort to realize the value. Now, you can afford to be more patient because there is more pressure for that realization of value to take place. So I'm just going to finish on one general point and then turn to a couple of companies. And this is the last one. This is another expression of the desirability of patience. I think this is a marvelous chart. I do carry it around with me, really, and I metaphorically have it under my pillow. I think it's a chart which an equity investor, and I'm an out-and-out equity investor, I believe in equities for the long run. An equity investor can comfort him or herself with this chart, because what it shows is a very long history of very good real returns from equities. This is the US equity market. The US has been best. I have to say, it's a bit of a cheat. The US has been best, but most markets, UK has given, this long-term return is 6.2% in real terms. The UK has given about 5.2%. That's a big difference in the end result, but 5.2% in real terms is still pretty healthy. Other markets have given 4.5% to 5.5%. So first, the long-term return has been quite remarkably consistent when you put it in as long a framework as this. going all the way back to the year dot, which as far as Credit Suisse is concerned was in 1849. But secondly, the great comfort of this chart is that even if you invested at a really lousy time, not quite the worst time, but if you invested when the market had already fallen quite a long way from the one standard deviation above trend and was on the trend line, even though you might have disaster in store for the next 2 or 3 years, within a very short period, you were back to the trend line. And so, for example, in 1929 to 33, the sharpest decline ever, and therefore the sharpest decline in this chart, you see that if you invested after the market had come back to the trend line, you had 3 years of nightmare ahead of you. But within 6 years, the market was back to the trend line. In other words, had produced from the moment of your very inopportune investment, it had still produced a 6.2% return in real terms. And so I think that is the great comfort in this. And of course, there's only one history, and the future may be quite unlike the one history that we've got. But this is quite a long history, and sufficiently long to give some comfort. So this is a support for investing in equities, investing for the long term, because you have to bear a lot of volatility on the way, quite clearly. To sum up, value is the main determinant of returns. I'll just say something about forecasting. We are not great believers in forecasting. There are so many examples of quite disastrous forecasts. The wonderful forecast that Thomas Watson made about the necessity of there being only 5 computers in the world. I came across this very good one the other day. Sir William Preece, chief engineer at the British Post Office, said in 1876, "The Americans have need of the telephone, but we do not. We have plenty of messenger boys." Paul Samuelson in 1980, in his classic textbook, Economics, had a graph which showed the USSR overtaking the US in GDP terms within 20 years. The Economist in 1998, when the price of oil was $10, had a cover which said, $5, here we come. Within 20 days, it reached $20. So anyway, forecasting, we all know, is extremely difficult. And we do not spend a lot of time on detailed macroeconomic forecasting, because if we could do it, of course we'd do it, because it would make all the difference. But knowing our limitations and the limitations of most forecasters, we don't. We are, on the other hand, spend quite a lot of time being skeptical about other people's forecasts. And some of the best returns we've had have come from that skepticism. But we don't make detailed forecasts ourselves. And I've just finished this before we come to individual stocks. Tell you the story, or remind you of the story of Kenneth Arrow, who won the Nobel Prize for Economics, I think twice, but possibly only once, and was employed by the US Air Force as a meteorologist in the Second World War. And he was asked to make medium and long-term forecasts, which he quickly realized were no better than randomly right. And he asked to be relieved of this duty. And the reply came back, "The commanding general is well aware that the figures are no good. However, they are essential for planning purposes." And I think that should be the status of forecasts. So now I go straight on, George, don't I? I don't stop at this point. I'm going to talk about a couple of companies. I'll talk about 2 companies. The first is Rio Tinto. This is not, I don't want to talk about a detailed valuation of Rio Tinto. We, unlike many value investors, do invest in commodity companies. I have to say, not a great idea just at the moment. And unfortunately, we hold Rio Tinto. But I believe that it will come right. When you invest in commodity companies, you have one great comfort, and that is that what they produce is always going to be needed. You don't know the quantum in which it's going to be needed, and you don't therefore know the price of the commodity. But you do know with more confidence than you can know of, let's say, a Nokia smartphone, that it is not going to go out of fashion. And so we do invest in commodities. People say, well, aren't there just too many uncertainties? There are lots of uncertainties, and we've been clobbered by the recent uncertainties. But I think there are uncertainties in almost every sector, other than those, and even those, in fact, do have some uncertainties, but other than those more steady Eddie type sectors, which in return for their steady Eddiness generally have very high valuations. Not always. We have invested in Johnson & Johnson. We don't believe there is any such thing as a value stock. We believe that different companies come into value territory at different times. I used to say we would never invest in Cisco, we would never invest in eBay because their valuations were sky high. Then we found ourselves investing in eBay and investing in Cisco because after 2002 their valuations dropped like a stone. Johnson & Johnson is the steadiest of all companies, with whatever it is, 53 years now, I think, of an increase in dividends. In 2009, companies like J&J and Pfizer, rather different because of the expiry of a major drug, but those companies came into our value territory. And so that kind of quality is occasionally obtainable at a low valuation. But generally speaking, you have to pay up for those kind of companies. And so I think for companies which genuinely represent deep value, you have to accept quite a lot of uncertainty. You certainly do in commodities. However, quality is important nonetheless. And that's the purpose of this particular illustration. If you invest in commodity companies, companies in which there is a major variable that is extremely unpredictable, you want to be sure of the quality of the assets, the quality of the management, and the quality of the balance sheet. And that is illustrated here. People say about iron ore, in fact, Wikipedia says about iron ore, it's a low margin, high volume business. You look at the margins here, they've never been below 30%. And on the right-hand side, you see why they've never been below 30%, because they've got the lowest cost assets, lowest cost of production assets in the world. So we want to be in top quality assets. Rio Tinto will always, it is inconceivable that Rio Tinto will not make a profit from iron ore. Famous last words. I can see those words ringing around in 2 or 3 years' time. It is very difficult to conceive of Rio Tinto not making a profit from iron ore. It can produce iron ore at $16 a ton, cheaper than any of the other major producers, and with freight and delivery and so on, $24 a ton. And the balance sheet is also the strongest in the sector. So we're not afraid of cyclical companies. We're not afraid of commodity companies. We don't mind investing in cyclical companies, provided that the quality of management and the quality of balance sheet are what we approve of. And then I will talk finally about one company, which is Fiat Group, where I immediately break the rule that I mentioned earlier, because when we invested in Fiat, it had quite high gearing. And we do break that rule with individual stocks, but not too much. So that in aggregate, the portfolio must always have a leverage which is a good deal lower than that of the index. But if we see something which we think is quite outstanding, then we may be prepared to tolerate the high leverage. So this was an investment we made in 2010, and the background was that the car sector as a whole was deeply depressed. One of the greatest maxims, I think, is the maxim of Herbert Stein, or Steen, who was chief economic advisor to Richard Nixon. which was, paraphrased, if it can't last, it won't last. We saw in the housing market after the financial crisis and in the car market unsustainably low levels of sales. We owned two home building stocks, Pulte Homes and D.R. Horton, in 2009 onwards. And with those stocks, we had no idea when there would be a revival of the housing market. But you cannot go on indefinitely having 400,000 or 500,000 houses being built when the trend rate of demand in the States is between 1 and 1.5 million. You might argue that the ownership level has come down permanently and that it's not 1.5 million anymore. It might be 1 million, but it's certainly nowhere close to 500,000. And so if it can't last, it won't last. We knew that there was going to be a pickup in housing at some point. We didn't know when. And so with those stocks, we normalize. We assumed that Pulte Homes, for example, just very roughly at its peak, had sold 330,000 houses at 270,000 a house. We assumed they would sell 250,000 houses at it doesn't matter. I'm not going to go. As I've forgotten the numbers, I'm not going to go into them. Anyway, we assumed a normal year in which they would have 20% gross margins. They'd done better than that in the past. They'd had 26, 27% margins. We assumed that they would have SG&A expenses of 10%. They'd done better than that. They got SG&A expenses down to 8.8%. And that gave us a nice round figure of about 700 million in net profit in this putative normal year at a time when their market cap was $2 billion. And that allowed us, not knowing when the normal year would come, the valuation was strong enough to allow us to be very patient. And similarly with cars, we didn't know when, but we had car sales down to 9 million or 9.5 million in the States. And that could not last forever unless the driving habits of Americans had changed fundamentally and forever. And of course, they have changed to a great extent. Again, I don't quite have these figures in my mind, but the figures are very, very striking. In something like 1965, Americans between the age of 18 and 30, 85% of them, I think, had driving licenses. And that figure is now less than 70%, or less than 75%. It's come down, anyway, very, very sharply. And so the aspiration to drive in your generation is very different from the aspiration to drive in my generation. My children did not immediately go out and get driving licenses when they were 17. And I imagine that many of you have not immediately gone out to get driving licenses. All the same, you would need a really sweeping change of aspiration and habit in the American population for that level of car sales that we saw in 2009 to be sustained. And so, sure enough, it has not been sustained. So this was the climate against which we made the investment. And the other factor is that you're seeing in the auto market this huge wave of technological change. We have two cars in my family. One of them, when you reverse, goes beep, beep, beep if you're backing towards a wall. The other does not go beep, beep, beep. And every time I drive it, I think this is going to lead to trouble because I'm going to forget that it doesn't go beep, 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 and we need to change the car. You have automatic braking, you have automatic parking. Within 10 years, we will have driverless cars. So there is a huge wave of technological change. And that is another impetus to a big increase in car sales over the next 10 years or so. Not wholly favouring the car companies, and Google and Tesla and so on would have something to say about it, but at least in part favouring the car companies. So those were the two overarching factors. And the first of those, the fact that car sales were so depressed, meant that the car stocks themselves were very depressed in 2010. And we invested in Fiat in 2010 at these sort of prices at about €9. Why did we do that? We did it because this was our valuation. The the key thing was that CNH, we felt, was entirely ignored at the time. Case New Holland, the second largest maker of agricultural machinery in the world, we valued at €6 a share, basing our valuation on trading profit. And at the time, the share price of the Fiat Group was only 8.5 times. The Brazilian car operation, was then first class. They had a 20% plus, a 23% share of the Brazilian car market, and they were achieving trading margins of 12%, which is extraordinary for the mass car market. And then there was Ferrari and Maserati, the luxury part of the business, extremely profitable, several hundred million in operating profit, and deserving of a very high multiple. We did not attribute to Ferrari a sort of luxury goods multiple. We attributed a BMW type multiple, which in fact has proven to be extremely conservative. And so we had, through a sum of the parts, which, as I said, is our favorite hunting ground, valuing each part on EV to EBIT, we had about 50% upside before taking any account of Chrysler. And Chrysler, the acquisition by Fiat of Chrysler, I think will be regarded as one of the deals of the century. The first 35% of Chrysler was acquired by Fiat for zero. 20% initially, 15% as a result of fulfilling various thresholds, and they paid for the remaining 65%, but not much. And we, in 2010, when we were valuing this, attributed nothing but a row of question marks to Chrysler, because it was very indeterminate at the time. It was very heavily loss-making, very heavily indebted. But it has come through in spades and achieved operating profit on a big scale much earlier than generally people had expected. So that was the original investment. We deduct from the EV to EBIT debt, pensions, we add various other stakes. We use EV to EBIT for these purposes because we would prefer to use PEs. We prefer to use earnings after everything. We don't like leaving anything behind. But when you have very depressed cyclical companies, their earnings are naturally going to be not much good at a time when their industry is in as much trouble as this was in 2010. And so you get a misleading guide, and you therefore have to resort to other measures at such times. We did not, when we invested, there was no apparent catalyst. But as so often happens when you invest in something which is deeply undervalued, either the market does something about it or the management does something about it. And in fact, within 5 months, the management under Sergio Marchionne, who is the deal maker of all time, announced the split of the company into two: Fiat Industrial, which holds CNH, and also the truck company, and then Fiat Auto, which holds the car companies. And subsequently, there's been an initial public offering of Ferrari. So there was no catalyst at the time. There was a lot of chat about a possible breakup of the group, but we didn't invest believing this was going to happen. As I say, catalysts so often produce themselves in deeply undervalued stocks. And so that split happened. Within a year, we had therefore stakes in two companies. We sold the auto company. It halved after we sold it, and we bought it back at $3. We held the CNH for a little while more, sold it in due course, and then we come to the final sale of the auto company, which we had bought back at the end of 2011, and we made a lot of money out of this. This was a very successful investment. We sold at a time when there was still upside. There was still, as you see at the very last figure on this page, 18% upside. Can you see that, in fact? Is it too small to see at the back? I'm sorry if it is. We don't normally like to sell before we reach our valuation target, because so often experience has shown that we should have held on, and we say that the best sell discipline is a walk around the block. But we were nervous at that time about the leverage, which remained very high. And where we have leverage in a company, we tend to move a little earlier than if there isn't leverage. And Fiat was also a company, unlike Renault, which was producing the goods. Fiat was a company which constantly promised jam tomorrow, and not jam today. So we sold, and altogether, every dollar that we put in Fiat Group at the beginning turned into $3. What we got right and what we got wrong, I mention these things because there is always room. There should always be enough room. There should be enough room in an assessment of a company to allow for things to go wrong. We got CNH very much right. Ferrari and Maserati we undervalued hugely. We were quite wrong about Brazil. Brazil turned deeply sour. We had €3 of value originally. By the end, we had less than €1 of value. Chrysler, we had question marks for. It turned out to be to work beautifully. And the auto cycle, we were right that it had to get a great deal better. We're now back to record levels of car sales. And there I'll stop and take questions.
Thank you very much. So you like then Canada because if you invest in commodities, I guess. How do you feel about Canada?
Well, our worst investment of the last 4 years is in Canada, and that is Barrick Gold. Barrick is a litany of mistakes. But occasionally one learns lessons. I mean, I hope you learn lessons all the time, but I learn lessons occasionally. And I've learned a big lesson from Barrick. In 2011, we invested in Barrick in 2006, and in fact in 2008 and 2009, it was a major contributor to performance, very good contributor. In 2011, they bought Equinox, which is a copper producer in Africa, and they paid a very high price. And at a time when the copper price itself was very high. And we wrote a letter of protest to Peter Monk. And we got a letter back, a very nice letter back. Of course, it didn't say anything that wasn't in the public domain, but it did confirm very strongly that they were not in the business of becoming a diversified mining company, which worried us because if they wanted to become more diversified, even after Equinox, they were still 90% gold, 10% copper, and they would have to get on a treadmill of endless acquisition, which concerned us, given Peter Monk's expansionist record. So we got this letter back which confirmed they were not going to do that kind of thing. And that encouraged us. It was a classic example of engagement with a company being extremely damaging. Had we not got the letter, we might well have sold, but it encouraged us, it reassured us, and we held. And the lesson I take from that, which I share with you, is that even if you've got a big gap between price and value, if a company does something very major of which you strongly disapprove, then, and if the share price gives you the opportunity, and the share price of Barrick continued to rise to a new high at that time, then take the opportunity and go. As to Canada, we don't have a view about Canada in general because we don't have views on countries really, but we've had some good investments and some bad investments in Canada. We're investors in Fairfax, and we're investors in Barrick. And I'm very optimistic about Barrick now, but I won't go into that now. I mean, I think you could see it 2 or 3 times in Barrick over the next. They will tell you that, don't they?
Thank you very much for coming and speaking with us today. You mentioned that you buy typically too early, and then also when prices go down, that's maybe more potential to get interesting.
Yeah.
Can you talk about how you position size with that in mind?
Sure, yeah. When we start, we usually start with a half holding, so 2.5%, and we look to increase that. It could be after weeks, it could be after months, but we aim to get to a full holding, sometimes at a slightly higher price, sometimes at a lower price. We do it in two chunks, simply to reduce the risk of wrong timing. And on the way out, we also tend to sell in two goes to reduce the risk of wrong timing. So 5% is our normal position. We won't hold more than 10%. 10% is the absolute max. That has been a wonderful discipline. At times when a stock has gone through 10%, we have, for 2 weeks every day, been pushing it back below 10%. And that so often has turned out to be a short-term spike in the stock, at a moment, of course, at which we are very enthusiastic about the company, otherwise we wouldn't be holding 10%. So we have a 10% limit. If the stock falls dramatically, then prima facie we're more interested. One of the great Lord Rothschilds said, you should buy when there's blood on the street, even if it's your own. I didn't know until recently that there was that suffix, even if it's your own. And of course, if it's somebody else's blood, it's relatively easy. If it's your own blood, it's more difficult. It's emotionally more difficult. And I think that does differentiate a small boutique deep value firm from large institutional firms where there is this cacophony of noise all the time and thousands of people, tremendous peer pressure to do things and generally to act in the way in which the market was moving on the previous day. And we try very hard to stay away from the freneticism of markets. And I don't have a Bloomberg on my desk because I know I would stare at it for half the day, which would be a terrible waste of time. But worse, it would impel us to do things which are better left undone. So we are interested, like a moth to the flame, in companies whose share prices have fallen, even if we already own them, or even especially if we already own them. And then we have to evaluate whether the deterioration in the fundamentals is exaggerated or not by the fall in the share price. Because, of course, there's been a deterioration. There wouldn't have been a fall in the share price otherwise. And if there is a deterioration, then we go back to a normal position and maybe to as much as a 7% position. So, I mean, I said I could give you lots of examples. Merck in 2004, when they withdrew Vioxx, their anti-arthritis painkiller, fell by 30% in an afternoon. And so that meant that the 5% position we had become a 3% position. We returned it to a 5% position the following day. It's not that that's automatically right. In fact, in the case of Merck, it wasn't right for a further 8 months, when there was a further drop in the share price of 12% after the first court case involving the Vioxx litigants, which the case went very badly for the company. And so there was another opportunity, and that was the moment, and the stock price then doubled over the next 18 months. We tend to limit ourselves to 3 bites of the cherry, because you can get addicted to these things, and you can pour good money after bad. And so we'll have 3 phases. They're not individual bites, but 3 phases of investment. We tend not to go back a 4th and 5th and 6th time, but instead just to stop. There's that phrase that if you're in a hole, you must know when to stop digging. So there is a point at which we stop digging. And of course, very often we regret that, but I think it keeps us sane.
So you've been quoted as saying that fundamental investors would make terrible foreign exchange traders because they're not very good at forecasting. Can you expand on that a little bit and talk about whether macro views have any place in value investing?
Yeah. Did I say that? I think I said something like that. I don't think I said exactly that. What I meant to say, what I meant to say was that I think that the art or the business of equity investing is fundamentally different from the art or the business of foreign exchange investing. And therefore, the people who do the one thing are probably not the people who are very good at doing the other thing. And you have to know which bag it is that you're good at carrying. So we don't attempt much in the way of foreign exchange forecasting. And that has been extremely painful in the last 3 years because we've had a lot in Japan And we did think, despite all our self-deprecation about ability to forecast currencies, we did think the yen would be very weak. But if we have a view on currencies, we tend to try to suppress it because we think it's probably wrong. And despite having that view, we didn't act on it. We didn't hedge. Very expensive. Macro in the last several years has been very important. I think that's in the nature of the financial crisis and the recovery from the financial crisis, that you've had QE sweeping the world and being much more important than all sorts of other fundamental influences. If we return to a normal world, then I would expect stock selection again to be preeminently important. And as for macro, of course macro is terrifically important to market returns. And if you could forecast macro well, then it would be worth doing and doing nothing else. But very few people are able to do it. And so what I'm saying, not very articulately, is that it isn't that macro isn't important. Of course, it is very important always, and it's been especially important in the last 5 years or so. But on the whole, people have more difficulty forecasting macro events than they do looking at individual companies. And with macro, as the word means, you're dealing in the realm of big ideas, the big idea which dominates the portfolio, exactly what we don't want to do. We want to have a diversified portfolio where there are a whole lot of different ideas at work at the same time. We have a couple of oil stocks in the portfolio. We've got a couple of auto stocks. There should be some kind of counterbalance in those two things. So I'm sorry, I don't think I answered that very well. Macro is very important, but it's not what we do, and most people don't have a great success, I think, in forecasting macro events.
Well, if I've got this right, you try to go for a 25% return every 2 to 3 years. At the same time, in the past, you've invested for Oxford, which is now an institution in its 10th century. So when you're responsible for something that is truly that long term, is there a difference you find in the way you invest for your fund versus what you invest in?
Yeah, yes, there is. First of all, to clarify the 25%, the 25% is the threshold that we're looking for before investing in a stock, a belief that a plausible 25% over the next 2 to 3 years is there. Where there is more risk, for example, with a highly leveraged company, we'd be looking for more than that, 40, 50%. We don't sell a stock until it gets to its valuation target, except sometimes, but generally we don't sell until it gets to its valuation target, unless there is something with supernormal potential, 50, 60%, in which case we would rummage around in the portfolio and find something to sell to produce the cash to buy the opportunity. But yes, so 25% is the threshold that we're looking for. With Oxford, yeah, very different. They have a broad portfolio. We are equity investors. We're not a one-stop shop. No investor would put all his or her money with us. We are for the equity portion, and in fact only a part of the equity portion, because we're doing something very specific, which is going to be very lumpy in returns, and there will be good 5-year periods and bad 5-year periods. We're for a part of the equity portion of an institution's assets or an individual's assets. We're not the whole caboodle. Oxford was the whole caboodle, and so Oxford did everything that you would expect from an endowment fund. It had a large private equity position. Private equity is very difficult, as you will all know. If you're not in the first quartile in private equity, you probably shouldn't be doing it. So how do you get in the first quartile? Only 25% of people can be in the first quartile. We happen to have at Oxford a chief investment officer recruited from the Wellcome Trust, whose speciality was private equity and has been terrifically good at it, choosing private equity managers. There's a certain amount of credit, there's a certain amount of absolute return funds, and there's a great deal of property which is inherited through the centuries. And so the answer is it's different. It's different for that reason, that what I do and I believe in very strongly is, I mean, for myself, I'm content to be 100% in equities, but I wouldn't impose that on other people. If you've got income and you can take a long-term view, therefore, with your investments, then I think the question one should ask oneself is, why not 100% equities? But if you've got income only from your endowment fund, for example, then you have to look at it rather differently and have a smoother return, because the college or the university is depending for its spending on what you can produce for it. And so you need to have a more balanced and diversified portfolio. The other reason it's different is that I was chairman of a committee. I was one of many, and had a very strong executive team. And you can't be chairman of a committee and try to direct everything in exactly the way that you want it. You have to be steering it in the way that makes sense for the management and for the committee as a whole.
Richard, could you please walk us through how you develop your own investment philosophy, or how you arrive at your today's investment philosophy? Because it's not something you are born with. So you mentioned how you deviated from the current traditional value investing and invest in a commodity company business. So could you kind of walk us through your thought processes, maybe who your biggest mentors were, things like that?
I mean, I do to some extent think that your investment philosophy is something that you're born with, even though, of course, you don't know it at the time. But then there's a lot that you don't know at the time. How did I come to have the investment philosophy, which I now express in the terms in which I do express them? I was interested in investing from a very early age, in a geekish kind of way. At the age of sort of 14 or 15, I was looking at the share price pages of the Daily Telegraph. And I was interested at an early age in shares which were priced very cheaply. That's to say, had very low prices. That didn't mean low valuations. I didn't know what a valuation was, but had very low prices. The first share I ever bought was in a company called Britannia Arrow. It had a share price of 6p. I didn't know at the time that this is a kind of investing which is called penny share investing. I only learnt that later. But I did think, almost sort of in an unexpressed way, but I think I did express it even, that I could lose 6p, but it might make 18p. And it was a company which had just changed its name. It had been part of Slater Walker. I don't know if that name means anything to you, but Slater Walker was one of the main victims of the secondary banking crisis in the UK in the early 70s. The holding company went bust. Jim Slater, who continued to be a great investor, died just within the last 6 months, in fact. And out of the holding company, there were a few survivors, and one of the survivors was its insurance company, which was called Slater Walker Insurance, and changed its name to Britannia Arrow. And I was drawn at the age of, whatever it was, 17, 18, to this very low-price share in a company which I thought had the opportunity to sort of wave a new flag. I bought News Corporation at 3 times earnings in 1981. I was always drawn to low PEs, low price cash flow models. So I think that is in the blood. And of course, as I say, I didn't know what I was doing. I didn't know what my philosophy was when I was a baby. I didn't know what I was doing when I was 18. And I only came to understand PE ratios and other multiples and methods of valuation in my 20s when I was working. But the curmudgeonly instinct to buy what appears cheap was there from the beginning. So I do think that is innate, and that you've either got it in the blood or you haven't. And if you've got it, then you can learn how to do it. But if you learn how to do it without having the thing in the blood, then you're probably trying to push a stone uphill. As for mentors, well, I mean, of course, Warren Buffett is a saint. And I read all his stuff, and I've made the pilgrimage, and I absolutely adored it, and I think he's completely wonderful. But he's not exactly, and he's a mentor in one sense, in that he's a contrarian, and he's a mentor in another sense, in that he says all these wonderful things about investment in a way which we can all understand, in a very homespun way. But I do think he's actually this is being recorded. I'm not going to use the words I was about to use. I think that he has confused the notion of value investing in the way that I described earlier, because people think that whatever Warren Buffett does must be value investing, and therefore treat an investment in Coca-Cola as a. And that means you've had in the last 6 years, you've had a real big divide between people who are going for companies with competitive moats and sustainable this and sustainable that, but generally more highly priced, and who call themselves value investors on the one hand, and the deep value investors on the other. So Warren Buffett is absolutely a mentor. Peter Cundill is a mentor. I do recommend the book I mentioned earlier. There's always what is it, George? There's always something to do. Thank you. There's always something to remember as well. There's a man called Peter Stormont Darling, who was chairman of Mercury Asset Management. I learnt my stuff at Mercury Asset Management, which at the time was, I would say, the best and it became the biggest, but it became the biggest after it had been the best fund manager in London. And one of the people who I certainly learned a good deal from was a man called Leonard Licht, who established really the investing ethos of Mercury and the business ethos of Mercury, which was part of the merchant bank Warburgs, was established by Sir Sigmund Warburg, the founder of the firm. The combination of those two was very powerful. And Leonard Licht had a very strong attention to cash flow, attention to assets, very quick decision-making, very courageous, and also a great believer in individuality and giving people the power to run their portfolios, completely opposed to committee-itis with huge amounts of process and endless committees which have to be passed through before a decision is made. That's probably enough mentors.
Curious to know your thoughts on activist investors from the perspective of a shareholder.
I'm sorry, I didn't quite catch that.
Activist investors?
Oh, right, yeah. They're a very good thing. But it can become an all-consuming obsession for the activist investor itself. The turbulation, whatever is going on in a particular company, can become all-consuming and be a tremendous distraction from what may be 90% of the rest of the portfolio. So I would say, on the whole, activists are very good things in pushing managements into doing things which, generally speaking, should be done. But not always, because some of them can be rather short-termist things. They can be trying to capture value extremely quickly when the long-term investment would be better served by leaving it alone. But I would say, generally speaking, they're a very good thing. But they do. I mean, I think they're rather sort of self-sacrificial in a way, because though some of the names that spring to mind don't immediately strike one as being self-sacrificial people, they can spend so much time devoted to one cause that they forget the rest.
So I recently read an article on Bloomberg, and it spoke about some of the hedge funds that had earned absolute returns that were phenomenal. You have guys like Dalio and George Soros. So there's obviously a lot of room for different investment philosophies.
Absolutely.
To be successful.
Yeah.
What do you think is the underlying characteristics that all great investors, despite the investment philosophy, share?
Well, first of all, I completely agree with that, and I should maybe make that clear. I mean, there are many ways to skin the cat. And you just have to be true to yourself in the way that you go about it. Because we in this room, I guess, are devoted to value investing, doesn't mean that growth investing is no good. There are plenty of people who do growth investing very well. It happens that we are drawn to the table in the investment casino, which is labeled low multiple, low expectations, in the belief that the banker is pushing erratically and gently money in the direction of the punters. And you can play well at that table or play badly at that table. At the growth table, the banker is taking a disproportionate amount of the stakes from the punters, because there are so many companies for which very high earnings growth is expected, and it simply isn't possible to achieve 20% year after year after year. And so the odds are against. But you can play well at that table. And you can be a George Soros. I mean, George Soros I think his particular strength is his absolute lack of regret. I think that's true. I think that he can cut a position, huge position, if it's going wrong after a week or so out, without a moment's compunction, whereas most of us mortals have that, behavioural thing that we get. We're anchored, and we find ourselves very deeply entrenched, and find it very difficult to acknowledge that it's not going right. And of course, as a value investor, you have this, in any case, contradiction to deal with, that the lower the price, the more attractive, at least in the first instance, it is. And so you should not be provoked to give up on it because it's going wrong. On the contrary, you should be more interested. And that's very difficult. So the second part of the question, what do they share? I think the one thing that all good investors share is a willingness to be different from the crowd, a braveness to be different from the crowd, and to be not to mind that they're being called a fool. So to respect other people who have done well, are doing well. You expect to continue to do well, but not necessarily to do what they say. I mean, I mentioned earlier my hedge fund friend who's been very successful, who said, I think value is stuffed. I have huge respect for him, but just because he says value is stuffed, I don't have to think value is stuffed. Just because he says that XYZ Corporation is the best thing since sliced bread, I don't have to believe that XYZ Corporation is the best thing. Because we all know that however good you are, you're only going to be right if you're George Soros, maybe 60% of the time, 65% of the time, and 55% is plenty, in fact. And therefore, to listen to experts is very dangerous because you might be listening to them in one of their 45% moments.
I was hoping you can speak on how you juggle with such a globally diversified portfolio in so many industries. And as an individual, would you recommend to be an expert in one industry or market, or do you think there's something fundamentally similar between all companies?
Thank you. I do think there's something fundamentally similar in all markets. I think that market psychology is broadly speaking the same in all markets. That cycle of greed and fear and denial and so forth, I think that is similar in all markets, in all types of market, not just stocks, but in every type of investment. So I think there is that great similarity, and that is a very, very important part of the whole business of investment. But of course, then you have the technicalities, and they're different in different industries and in different countries. And there you do need some specialist expertise. We have a team of people who, on the whole, have been doing it for a long time. I am not quite the oldest, but I've been doing it for 35 years. And we have two others who've been doing it for 30 years each, who are both two Japanese experts, another 30 years who is a European person, somebody else who was an IT person originally before going into investment, covered consumer goods companies, covered emerging markets. We have two emerging market specialists. So, in other words, there have to be specialities. We are all broadly generalists, but we all come with our baggage, our specialist baggage from the past, and make use of that specialist baggage. All the same, we're a small firm. We've got an investment team of 12 people. And I think the real answer is that it's terribly important to focus on the key issues. And I think actually it's an advantage. The very, very big teams have, of course, an advantage in bandwidth and breadth of coverage and depth of coverage too, but they have a tremendous disadvantage in decision-making efficiency. The difficulty of weighing up input from 20 different people, the difficulty of trying to arrive at a consensus, if that's the method of decision-making of 20, and therefore they gravitate towards the index. And and for business and decision-making reasons tend to become index huggers. So I think small firms in decision-making have a huge advantage, even though they have to limit the universe which they cover in terms of number of stocks. In our global portfolios, we invest only in companies with more than $10 billion in market cap. So despite the disadvantages in terms of reduced breadth of research, I think there are tremendous advantages for smallness. Small is beautiful in investment.
What is the most important thing you learned in investing and life over the last 25 years?
Gosh, I don't know that I haven't got a single good answer there. I mean, quite a few things buzz through my mind, one of which is that however bad it gets, it can always get worse. Another is just the importance of a combination of common sense and courage. I mean, Warren Buffett has said that, I think, really good thing, that common sense is so much more important than intelligence. I mean, intelligence is very important, but he would rather have somebody with a lot of common sense than somebody who's won the Nobel Prize. So common sense, courage, conviction, those the attributes that you need, I think I have learnt more about over the last 25 years. I'll write to you with a better answer.
Thank you very much.